a little bit about these numbers, also the job situation with Ron Davari. He is the CEO of NewOak Capital, joining us once again. So, Ron, just one of many reports we're going to get before the big jobs number. But just with some of that information, auto sector not so great, government, nonprofit not looking so good. One of the areas they say might be looking better is industrial. We get that ISM number. So what are you making of this job situation right now?
Well, I think, as you mentioned, the manufacturing should slowly come back because we have had very low inventory. We're getting into the obviously holiday season. There will be additional production in order to meet that. We're seeing Asia recovering. That's really a positive. But the latest information from the Midwest was not that really great. On the manufacturing side, it still looks like there's a bit of weakness, and corporate spending is very low, and that really indicates that they're not going to hire a lot of people ahead of this what we consider jobless growth. So my personal feeling is that we've got to continue thinking that we're not going to have a flurry of jobs, and the public has to adjust with that. And I think we're looking at, we've got to have an outlook about a year forward in terms of...
And let's talk a little bit about that, because one of the things that we continually say is the trend is better. It's been the trend is better since the beginning of the year. Right. But you still have expectations that 500,000 people a week plus are filing for unemployment. I mean, we're not talking about job growth yet.
No, absolutely. The job numbers are actually tend to be lagging indicators, right? So people are really, the market is looking about a year forward. We are seeing that essentially less and less reduction in jobs, but not still reduction. Still reduction. So let's not go too far in thinking that.
Do the lagging indicators, though, now with this market that the business news is so pervasive in any sort of news outlet. Sure. We keep on saying that jobs are a lagging indicator, but that still doesn't make the consumer feel any better about the economy and their personal circumstance, right? And that affects spending, and we know that affects what we see in the markets every day. So how are you handling that? That kind of that interaction?
Well, you have to make sure that you're going with the markets, not with the real economy. That's one of the things surprises when you get out of the graduate school and say, well, you mean I don't have to pay attention to the real economy? But you got to be ahead of it. Markets are always ahead of the real economy, and I think that's what we're seeing.
All right, that's where we're going to have to leave it. Thank you so much, Ron. We'll be talking to you again soon.
We've talked so much about Bank of America this morning, but Chevron also making some changes, tapping a veteran of the company to succeed the chairman and CEO, David O'Reilly. So we're going to talk about that. We've got some other companies on our watch list as well. In the Fox 50 this morning, Ron Davari from NewOak Capital, where he's Chief Executive Officer, is with us. Good to see you, Ron.
Good morning.
Thanks for coming in. So we take a look at our index, the Fox 50, made up of some of the biggest companies in the world. Chevron is one of them. Absolutely. So, again, B of A gets a lot of attention, but what about the changing of the guard at Chevron and what the future holds for the big oil companies?
We're actually positive on the oil companies. I think the fact that Asia has survived and now is looking at major growth, I think that's going to look good for oil prices, and I think oil prices will bring down energy.
Because these stocks haven't done great. They've been. I mean, this oil's obviously way down from its highs, even though it's at $70. So, and so is the stock, by the way, coincidentally enough. So, would you be a buyer of some of the oil stocks, or even Chevron in particular?
I would actually. I think the biggest thing about oil is really refined product, and I think the capacity for refining is actually is indicating that there is going to be a shortage going forward. Yeah. Even though we got a lot of stockpiles of oil out there, so I'm actually positive on refiners and people who are actually getting the product in the hands of the consumer at the end of the day.
All right, no trades in the pre-market. We'll watch Chevron today. Another one we're talking about, if you heard us in the last segment, was Nike. Well, Michael Vick apparently is back, being endorsed by Nike, and we just had the earnings the other day, and then the 2 nights ago actually. So yesterday really is when the stock moved on that. What do you think of Nike these days?
Again, I think as we get more recovery and spending will come back, I think I think a play on Nike would be a good stock to have.
Yeah, because the question is when people want to pay $100 or more for sneakers, when the economy, and when will they again, as opposed to just being all right? Because for a while it's just the craze, you had to have them. I don't know if it's like that anymore.
You're right. I think, but I think the consumer is going to get tired of not spending, and
We're Americans after all here.
Exactly, and I think that then there's the rest of the world that's looking for brand. And I think as you know, I just came back from Korea, and I just saw that there is a whole different mood out there.
Well, it's big in Asia, right, Nike?
Yeah, Nike is big in Asia, and brand names are generally big in
Well, it's funny. I remember from the Olympics when the basketball team went over, and LeBron James and Kobe Bryant and these types of, they're huge in China. They have the big billboards of these guys up in China. So the growth potential there has got to be huge for not just Nike, but for a lot of companies. But you have because people there, it is a premium product, right? People want to have it still.
Absolutely. I think the whole world is looking at brands and brand building, and we tend to actually in the U.S. commoditize some of these. But the reality is people pay up for brand, and Nike is a great brand.
Good enough.
So I think we're very positive on them.
All right, good enough. Good to see you, Ron. By the way, we'll leave it there for now. But that's a little look at our Fox 50 index, which has been pretty much in line with the rest of the market here. Probably will open lower today. Ashley, let's go back over to you now as you rejoin us from London. Peter Barisi is with me from D.C. He's an economist at the University of Maryland and a regular here at Fox Business, as is Ron Davari, CEO of NewOak Capital here in New York. What do you think, Peter? 551 on jobless. Let's start there with the employment picture. What do you make of it?
Yeah, well, the recovery is clearly waffling. The rate of decline, or the rate of decline in initial jobless claims has tailed off, which tells us we're going to continue bleeding jobs. This is very inconsistent with what we've been getting in the monthly job data, which I think will likely be revised up in terms of job losses. Over on the personal income side, I mean, basically, you've got cash for clunkers there. If you pull that out, probably personal consumption grew, very modestly for the month. So we shouldn't make much more of that than it is.
Okay, that's fair enough, because the spending rise here is the largest since October of 2001. But your point, it's all clunkers.
Essentially, that's it. I think if you take apart it and take a look at the service number or the non-durable goods number, you're going to find a very small increase.
All right, let me go to Ron Davari for his take on all this. Is Peter right that the data, and there have been some examples of it this week. Yesterday was another example on the manufacturing side, that maybe things aren't getting better as quickly as we thought?
Exactly, but I think the market pretty much expects this. This is going to be a jobless recovery.
Right.
And I think the market is going to be very patient with these numbers. That's one of the market reaction is not a surprise to us. I think these numbers are very consistent with what we're going to be. It's going to be a slow, shallow recovery.
Well, my question, I guess, for you, for somebody who's trying to price markets, and it's what you do across the spectrum here, we're not getting very much of a big surprise this morning. The futures are pretty much where they are. That said, could we, as Peter's suggesting, and I'll get him to weigh in on this in a moment, have a situation where markets do see some data here, if it's not showing the recovery we thought, use that as an excuse to finally sell off a little bit?
I think the market will have some volatility. There will be some selling. Some people will take the profit before the end of the fourth quarter. All of that, but the bottom line is that this is all within the parameters of the market players.
Yeah.
What is going to drive the market is really liquidity. We have said that on the program before. Liquidity is really coming back to the market. The rest of the world is looking at U.S. as being very cheap, and they're gonna bid it up. And that's what we're seeing also in the toxic asset side of things.
Yep.
The toxic mortgages are now in. People are leveraging this stuff.
So we're back to the future there.
Back to the future, definitely, and maybe perhaps some bonuses will come back there as well.
That's what you're hoping for, right?
Exactly.
What do you think, Peter, in terms of how markets price this? Because you seem to think the recovery is not going to be as quick as some people have been predicting here.
Yeah, well, my numbers on GDP for third quarter are half what everybody else's are, but they are positive. My feeling is as long as we have some growth, with the liquidity that's in the market, we will continue to move upward in the market through the end of the year. In the new year, the first quarter, then we're going to have to start to see some increase in profits. As long as the economy grows, say at 1.5%, 2% a year, that's enough, even if we don't create jobs, to give us a buoyant stock market, especially when you consider the growth in Asia, because so many companies are making so much money there. My feeling is the prospects for the market remain, on the whole, quite good. Better than
those for the economy. Peter, before we let you go, quick take on tomorrow. That's the big number, right? The jobs number. What are you expecting?
Oh, I'm expecting a loss of about 190,000. But, you know, we're forecasting what the Labor Department number is. I think at the end of the day, they're likely to revise those up a bit because they're wholly inconsistent with us having these jobless claims still in the range of over 500,000.
Yeah.
I mean, a healthy economy is 350. But, you know, that's another story.
All right,
for the geeks.
Is another story. For all us geeks, well, we like that, too, a little bit. Dig into the weeds, as we say. Peter, thanks. Ron Davari, thanks to you as well.